Hey guys, today we are going to talk about the cash flow calculation of a investment property and how we can recognize a good investment property, especially in a high interest rate environment. First of all, I would like to address a question that many of my home buyers, especially first-time buyers, have been consulting me about. They often hear others advising against purchasing an investment property in a high interest rate environment. So why do many people hold such a viewpoint, and what is underlying the logic behind it? So the return on the investment in the real estate world can be divided into two parts, which I have mentioned before in my previous video. The first is the capital appreciation, and the second is the rental income. As I have mentioned before, I personally believe that rental income is the essential indicator for an investment property. Meanwhile, capital appreciation is subject to high uncertainty in the short term or medium term period, and carries a more speculative nature. Therefore, the increase in the central bank's benchmark interest rate directly affects the returns on the investment properties from these two aspects. So how exactly does it work? Here is an Excel sheet, as you can see in the video, that is used to calculate the return on a investment property to help everyone understand the complete cash flow and the returns that constitute an investment property. The first number to input is the total monthly rent. The blue cells are those that can be edited. The effective gross income can easily be calculated by minus the vacancy rate in the current Windsor real estate market. Below are the numbers that I was using to get the key indicators when I was searching for my own investment property. So you can take a look at the numbers and use them as your reference. So the next comes with the operating expenses, including the property tax, home insurance, routine maintenance, etc. I usually outsource the lawn mowing and snow removal to the tenants directly, while I will provide all the needed equipment. So the cost is quite negligible here, so I just put 0 there. After calculating all the expenses, we can obtain the net operating income of the rental property. So let's assume that the property is purchased for say $400,000, and it is acquired with a standard 25-year mortgage with 20% down payment, like a regular home buyer's purchase. This will allow us to obtain two essential investment indicators for this investment property: the cap rate and DCR. Here I'll explain those two indicators for the beginner investors. The official term for cap rate is actually capitalization rate, which is similar to the interest rate earned on the money deposited in the bank. The formula to calculate the cap rate is net operating income divided by the purchase price. The DCR stands for the debt coverage ratio, and it is commonly used to determine whether a commercial property generates positive or negative cash flow. So if the DCR is greater than 1, it means that the property will have positive cash flow each month. Then if it is less than 1, it indicates the negative cash flow for the property. So based on the data above, we can obtain two crucial indicators that measure the cash flow of the property. With this information, we can now address the underlying logic behind the close relationship between the investment property returns and the benchmark interest rates. So with the current approximately 6% mortgage interest rate, we can observe that the cap rate is 7.27% and the DCR stands at the positive cash flow return of 1.18. This means that the property is expected to generate an annual income of around $4,500, resulting in approximately an annual return rate of 5.25%. However, if the benchmark interest rate continues to arise, let's say the mortgage interest rate increases to 8%, we will see the cap rate remains unchanged. This indicator only considers the property's income and does not account for borrowing costs. However, the DCR instead would drop to 0.99, leading to a negative cash flow of $215 per year, resulting in a negative return rate of minus 0.25%. So with this being said, let's shift our focus to the yield rate of the 2-year and 10-year US Treasury bonds from 2023 to the present. The former fluctuates between approximately 4% to 5%, while the latter fluctuates between approximately 3.25% to 4%. As known to most people, US Treasury bonds are widely recognized as the risk-free rates, given the backing of the US government. When the above-mentioned mortgage interest rate is at 6%, the return on the real estate investment, at this case, will be 5.25%, kind of marginally outperforms the yield of the US Treasury bonds. However, if the benchmark interest rates continue to rise, the yield rates of US Treasury bonds will also continue to rise. Meanwhile, the core indicator of real estate investment, DCR, will experience a significant decline. This will result in a drastic contraction of the return on this investment property, resulting in a huge underperformance of such investment. So this illustrates the fundamental connection between the investment property returns and the benchmark interest rates. This explanation also addresses the earlier question posed by buyers about why it is advisable to refrain from purchasing an investment property in a high interest rate environment. However, in my previous explanation, for the sake of simplifying the representation of the investment property cash flow, I intentionally overlooked two crucial points. Firstly, within the monthly mortgage payment made by the buyer, apart from loan interest, there is also a portion dedicated to the principal repayment. Secondly, another component of the property return is the appreciation in the value of the property itself. So back to my previous example, the Excel sheet will calculate, based on the bank's loan algorithm, that $6,630 of the annual mortgage payment goes towards the principal repayment. Additionally, assuming that the Canadian real estate market's long-term average appreciation rate is equal to the inflation rate, which is around 2%, then the property's annual appreciation would be approximately $8,000. Even though in reality, based on the average price trends of Canadian real estate market over the past 40 years, the annual growth rate is actually more than 2%. But just for this example, let's say just it's 2%. Okay, so taking these two factors into consideration, the investment project would actually bring you approximately $19,000 in value annually. This initial investment in this investment property, considering all the expenses, would be around $86,000. Consequently, the calculated annual return on the investment for this project would be approximately 22%. So at the end of this spreadsheet, there's also a cash flow calculation for the mortgage, helping buyers understand how much of their monthly payments go towards the principal and the interest in two different parts. So if anyone is interested, feel free to reach out to me directly so I can send you the Excel spreadsheet for you to do your own research. So of course, the spreadsheet does not factor in the costs associated with selling the property in the future because the capital gain tax is directly linked to the homeowner's personal income level. As a result, an accurate value cannot be determined. The previously calculated return of around 22% is merely a simple numerical projection, and no definitive conclusions can be drawn without actually selling the property. It is clear that the transaction cost for buying and selling properties are much higher than other regular commodities, which is why I would advise my clients to be prepared for a long-term ownership. What's more is that the long-term real estate trends in Canada have shown significant fluctuations in the housing prices. So timing the sale of property becomes particularly important. This timing does not represent speculating or predicting the market. It means that you have to wait until the right time comes up to sell your property. By doing that, you can maximize the best value out of this property. So in a stagnant or even sagging housing market, it is quite essential to hold on to the property firmly and avoid being forced to sell at a loss. That's why I repeatedly emphasize that having a positive cash flow from the property itself is a critically important indicator. In the long run, the prices of all commodities tend to revert to its intrinsic value. This principle aligns with the teachings of Benjamin Graham, known as the father of value investing, who always says, in the short run, the market is a voting machine, but in the long run, it is always a weighing machine. So the long-term value of the real estate relies on fundamentals. When interest rate hikes strike, the entire financial market's fundamentals are changed. Many individuals might be compelled to sell their properties due to deteriorating cash flow, and even numerous small and medium-sized banks in the United States nowadays are facing bankruptcies during such interest rate surges. On the other hand, those who rely on real estate assets to improve their cash flow rather than being burdened by real estate liabilities can successfully weather the financial storms and achieve the true financial freedom. Okay, that's everything for today. Thanks so much for watching. Bye.